What's going on, everyone? It's Griffin here, and in today's video we're going to be speaking about dividend focused ETFs that distribute hefty yields, hopefully enough to even pay for your monthly phone bill. Wouldn't that be nice? I'm well aware of the fact that the audience here on YouTube loves dividends. I mean, honestly, what's there not to love about recurring passive portfolio income? And since we haven't spoken about dividends or ETFs for that matter in over a month on the channel, I thought this would be a great opportunity to do so. So in today's video, we're going to be covering 3 dividend ETFs that each trade on American exchanges. And not to worry, even if you're Canadian here, don't necessarily just rule them out right away just because they trade in USD. These might still very well be of interest to you. And even at that, I've got you covered. I made a video about a month ago that I'm overlaying right here where I covered Canadian dividend focused ETFs. Definitely make sure to check that one out if you haven't already. Alright, so jumping into the first dividend ETF in today's video, we have the iShares Emerging Markets Dividend ETF, ticker symbol DVYE on the NYSE ARCA, which currently trades for right around $40 per share. Now, if you remember from a couple of weeks back, I released this video right here speaking about emerging markets as an investment opportunity. And in that video, we went over some concrete data around what seems to be a massive opportunity for investment in emerging markets over the next decade or so. I won't spoil that video for you if you haven't managed to already watch it, but essentially the gist of it is that emerging markets are expected to massively increase their international output over the next 10 years or so. And generally speaking, what that means is that equities in those countries that are contributing to that increased GDP and international exports will somewhat follow this increase in macroeconomic development. So of course, I'm always on the lookout for interesting equities as well as exchange traded funds that now invest also in emerging markets. And as a Canadian investor myself, and I'm sure a lot of people watching this are either Canadian or American, we aren't necessarily all too familiar with emerging market equities specifically. We do know the big ones like Alibaba, JD, as well as other larger and well-known companies. But for the most part, at least I'm not aware of the hundreds or thousands of companies that operate in emerging markets. So what's great here about an emerging market ETF is that you can easily invest into the emerging market space and gain exposure to hundreds of companies that are within those markets. So back to the ETF in question though, this fund currently has just shy of $900 million in net assets under management, spread out across 95 individual holdings from multiple different emerging markets. In fact, we spoke about which particular emerging markets were poised for the most growth over the next decade in that previous video, and those were India, China, Brazil, and Russia, which this fund is heavily focused on, with over 50% of the fund's holdings operating in one of those countries. Now, regarding the fund's sector breakdown, we can see that somewhat unsurprisingly, most of the companies fall within either the financials, energy, utility, material, or real estate industries, which are better known for distributing dividends to shareholders due to the nature of these businesses. I won't really go over any of the individual holdings within this fund because most of them you probably aren't too familiar with, but if you are interested in investing in this emerging market dividend fund, then I definitely recommend that you do take a little bit of time to look over at least the top holdings. Regarding the fund's financial metrics, they actually aren't too bad, with an average price to book ratio of only 1.05, which is great, and an average PE ratio of 8.44, which is quite low even for these industries and countries. The fund also has a reasonable dividend yield of 4.7% over the past 12 months, which is great for any dividend position. And when we consider the 30-day SEC yield, we're looking at 6.17% after the MER fees, which is definitely higher than market average. With that said, as with most dividend-focused exchange-traded funds, the management expense ratio is a little bit pricier than some other broad market index funds at 0.49%, but considering the nice dividend yield after fees, this could still be a great option for dividend income while also being exposed to emerging equities over the coming years. So from what I could gather in my research on this fund, this seems to be a nice balance between having exposure to those emerging markets in industries that also are more well known for distributing a higher distribution out to shareholders in the form of dividend income. I'd love to know what your thoughts are on both emerging markets and dividend exchange traded funds, so make sure to let me know down in the comments what you think of this first exchange traded fund. And if you're enjoying this video up to now, make sure to smash the like button. All right, moving on to the second dividend-focused exchange-traded fund in today's video, we have the SPDR S&P Global Dividend ETF. That was a mouthful, but the ticker symbol is WDIV on the NYSE ARCA, which currently trades for right around $69 per share. This ETF is quite a bit different than the last one in that it invests in international equities that have promising dividend distributions regardless of the country of origin, instead of only focusing on the emerging markets. In fact, this ETF seeks to offer exposure to high dividend yielding global firms that follow a managed dividend policy of having increasing or stable dividends for at least 10 consecutive years. If you happen to watch my recent video where we went over specific criteria that I personally look for as a dividend investor when I'm hand selecting quality dividend stocks, then you would know that a 10-year consecutive dividend payment is definitely a plus here. Now, this is a much smaller fund than the last one, at roughly $315 million in net assets under management, but that doesn't shy it away from being a strong contender nonetheless. Now let's actually speak about this ETF's holdings, and what's interesting about this exchange traded fund is that it limits the maximum weighting per individual stock to a maximum of 3% each, and this is also the case for the industries that the fund is investing in, along with the markets themselves, where neither of these can exceed 25% weighted average apiece. So yeah, taking a look here at sector breakdown, we can see that right around 25% of the fund is in financials, followed by utilities, real estate, energy, and communication. Nothing all too surprising for a dividend-focused ETF. What I do find intriguing though is the fact that regarding a geographical breakdown, take a look at this. Canada and the United States are neck and neck, with Japan following in third. This demonstrates firsthand the quality of Canadian dividend stocks, which shouldn't be underplayed. The Canadian market has some fantastic dividend stocks in the financial, utility, and energy industries that are great for pretty much any dividend-focused portfolio, but let's get back to the financial figures of this fund. It currently holds 96 individual positions with an average PE ratio of 12.63 and an average PB ratio of 1.29. So a little bit pricier here than the emerging markets ETF. Over the past couple of months, this ETF has been experiencing some relatively nice price increases. So in all honesty, it probably would have been better to be buying into this fund a couple of months back. But nonetheless, we're looking at an ETF that still has a 12-month trailing yield of 4.69%, which again is in the higher range for dividend ETFs. So if you're looking for global exposure through an ETF while also collecting nice dividend checks along the way, then the WDIV ETF is definitely worth looking into. And last but not least, would this video even be an ETF video if Vanguard funds did not make an appearance? Well, for this third and last dividend ETF in today's video, we have an ETF that invests exclusively in American firms. It is the Vanguard High Dividend Yield ETF, ticker VYM, which some of you may be familiar with, as this is one of the most popular American high dividend funds. Shares of this ETF currently trade for right around 105 USD a piece, making it quite accessible to most investors. And what's fantastic about this ETF is that even though the yield is quite a bit lower than the past two funds at roughly 2.68%, well, the management expense ratio is among the lowest that you can find for this type of ETF at only 0.06%. This is typically the type of management expense ratio that you would see more on a broad market index fund rather than a more narrowed down investment vehicle such as a high dividend ETF. But yeah, so this fund is definitely on the larger side at $48 billion in assets under management, which is a heck of a lot larger than the two last ones. And although the yield isn't necessarily the highest at only 2.68%, well, with every investment, we need to also take into account the full picture for returns. This takes into account both the dividend income earned over the course of time that you held this investment, but then also the capital gains experienced in regards to the appreciation of the fund's value over time, both of which make for the overall return of the fund in question. And so based on the holdings for this ETF more specifically, the returns over the past decade have been stellar, especially over the last year. Since inception, the average yearly returns of this fund have been 8.3%. And yeah, over the past year, this has obviously been eclipsed. Now, of course, this past year has been an above average year for returns, and that certainly does not indicate future performance. But even still, the companies that this fund holds are staple American enterprises. Coming in as the largest position, we have JP Morgan Chase, followed by Johnson & Johnson, Home Depot, P&G, Bank of America, and other larger cap blue chip stocks that also happen to distribute a nice dividend. Honestly, this ETF isn't necessarily anything new or out of the ordinary, but you don't always need the flashiest investment to produce more consistent dividend income along with appreciation over time, as this fund has demonstrated. And even though this ETF has run up quite substantially over the past year, placing the PE at a much higher 20.4x, well, this is definitely still an ETF that you might want to keep an eye on or add to your watch list, as it's sort of a best of both worlds, investing in some high quality American blue chip stocks that also happen to distribute a nice yield, all of which at a very low management expense ratio. And finally, let's quickly speak about how much capital you would need invested across these three exchange traded funds if you wanted to pay for a monthly $50 phone bill, for example. Well, considering the dividend yield of those three funds, this would average out to around 4.51% if the funds were to be split evenly across those three ETFs, which I do realize isn't necessarily indicative or accurate of a real life portfolio, but nonetheless around 4.51%. And then from there, with an average yield of 4.51%, it's pretty simple to calculate. $50 per month times 12, we're looking at around $600 per year that would need to be covered by dividends. And the reason why I put that on a yearly schedule is because dividend yields are actually calculated on a yearly basis, regardless of if the company or the funds distribute their dividends on a monthly, quarterly, or even annual distribution schedule. It's always brought back to a yearly time frame. So at $600 per year in dividends needed, we divide that by 4.51% and we get right around $13,300 invested across an average of those funds to be able to pay for a monthly $50 phone bill. It's really as simple as that. And even though these funds don't consistently pay out a dividend on a monthly schedule, it really doesn't matter. And you should not be looking for individual dividend stocks or even ETFs for that matter that do pay out on a monthly schedule as one of your main criteria, because this really doesn't matter as a result of what I just said earlier. The actual dollar figure is going to be the same regardless of the actual frequency of those dividend distributions. So that pretty well covers today's video, and I really hope you enjoyed it. If you did, make sure to smash the like button and let me know down below what you thought of these three dividend ETFs, and if you have any others on your radar or in your portfolio, I'd love to know. I also wanted to quickly mention here that since Canada Day is this week on July 1st, which is Thursday, I decided to run a sale on my course, which is the first time I ever do that, and I'm only going to mention it briefly here. I'm running a 25% off sale. You can find a link down below in the description. If you've been thinking of maybe enrolling, then this would be a good time of doing so, because I don't really plan on running another sale for, well, the foreseeable future. I'm not really sure when that's going to be, but right now you can get the 60 video lecture stock market investing course that's going to give you all the tools necessary to properly navigate the market and craft your own portfolio based on your needs as an investor. You can get that right now for 25% off. Check the link down below. So with that said, thanks a lot for watching today's video, and I will see you in the next one.